Welcome back. Robert Omotunde, investment analyst with AfriInvest, joins me now as we review the Treasury's bills and bond market for this week. Good morning to you, Robert. Thank you so much for joining me.
Morning, Harry.
So this week saw a lot of topsy-turvy activities at the fixed income segment of the market, and expectedly we saw that the Debt Management Office held a bond auction on Wednesday, and so investors in the bonds segment of the market actually were cautious in their trading. But just give us an overview of how the market fared.
Okay, during the week, what we saw was what had been expected following the release of inflation figures for March. We saw inflation rising to as high as 12.8% for the month of March, and the implication of this was that the benchmark rate is at 12%, and by economic analysis, you would say the real return is negative. And we had expected that investors were going to take this into cognizance when they are pricing various fixed income instruments in the market. So what we saw in the week, particularly at the auction on Wednesday, was a repricing of most of the instruments. You recall that in February 2020, in January 2026, and in March 2036 instruments were auctioned on Wednesday. And as against what we've always witnessed, in the last auction, when the three instruments were auctioned simultaneously, we saw a higher increase in marginal rates, so that's the stop rate for the auction. On the average, it was about 0.6%, while we reported 0.7% for the February 2020 instrument. January 2026 was about 0.5%, while the March 2036 was about 0.6%. What this is telling us is that the rising price level is also having impact on the general interest rate environment. And this is more or less what we'll likely see until the next MPC meeting, when we would expect, based on their full guidance, that the Monetary Policy Committee will want to take a particular action as regarding this. But from the monetary policy management angle, the CBN has been conducting OMO auction, even though with the level of liquidity in the system, we would expect that the CBN should take some breather, but we are not seeing that at all. Liquidity level is below 500 billion, and in the week, there have been two OMO auctions that have been conducted. So you've seen rates react, both at the money market rate but the fixed income end of the market has been relatively stable after we saw the initial reaction to the inflation figures.
Yeah, but then we also noticed that investors, at the Treasury bills market didn't favor long-dated bills. They favored, of course, the short and intermediate ends. It seems as if investors actually lost confidence following the release of those inflation numbers.
Well, as characteristic of what we've always witnessed, there are categories of funds in the market, and if you recall, those who play within the Treasury bills market, they are majorly banks and some insurance companies. In which case, the liquidity they have definite tenor, and for the long-dated T-bill, you have as high as 35 days, which is about a 1-year period. And some funds are just within 6 months to 3 months horizon. And so some investors always seen higher activity within that end of the market. We attribute it majorly to the nature of funds, in the market. But because if you analyze, yield for a 65-day instrument is relatively more attractive than what you get if you are doing a 3 months or a 6 months or 184-day instrument. So the activities that we have seen, we attribute it majorly to the nature of funds in the market.
Well, Robert, so from your analysis and taking a look at how investors are taking position, some cautiously, some just going brazenly into the market, what's your expectation for next week?
Well, we always reiterated the fact that the economy is currently challenged, and we have a lot of issues that are bothering investors. And these are the factors that will still continue to play out even in the coming week. For the fixed income end, what we would expect is investors will continue to study the situation of things to take specific investment decisions because we still note the fact that that market is still a little relatively stable than what you have on the other end. So in the coming week, we would expect some uh, uh, tempered reaction. We've seen the initial reaction to inflation figures. So what we will likely see in the coming week will be investment taking position based on the nature of funds that they have and their investment horizon, at this time. So we don't expect any major or any significant reaction by the market. So market will still be, more or less stable in the coming week.
Do you expect to see more investors favor short to medium, dated bills, or do you think that they'll just take the plunge and begin to look more at long-dated bonds and bills?
Well, for bills, like I said earlier, it's more likely that investors will take position based on, what their investment horizon will be, because whether you're looking at it from the shorter end or the longer end of the curve, you will recall that the yield at the longer end is much more attractive. So what now determines where you take position, for most investors will be the risk that they are pricing and the nature of the fund that think they have at hand. So for next week, it will still be more of investors choosing between these two end of the curve, whether the shorter end of the curve or looking at the long dated T-bills.
Well, thank you so much, Robert, for sharing your perspectives with us this morning on the program. To have a profitable day.
Thank you. All right.